Ever wished your money could make more money without you lifting a finger? Like a financial superhero, silently battling inflation and building your wealth while you're off living your best life? Well, for many, that dream feels like a distant fantasy, shrouded in the confusing jargon of Wall Street and the intimidating prospect of picking the right stocks. You've heard of investing, sure, but it often conjures images of frantic day trading, nerve-wracking market predictions, and the nagging fear of losing everything. It sounds like a full-time job in itself, reserved for those with fancy degrees and insider information. But what if I told you there's a powerful, proven way to invest that doesn't require you to be a financial guru, spend hours glued to stock tickers, or even make a single active trade? A method that embraces simplicity, leverages the power of time, and has consistently outperformed active investing for most people over the long run? I'm talking about passive investing, and today, we're going to dive deep into how you can put this strategy to work for you, specifically through one of Canada's most popular and user-friendly platforms, Wealthsimple. Forget the stock market gurus promising quick riches, the elaborate trading strategies, and the endless stream of financial news designed to make you feel like you're missing out. Passive investing is fundamentally different. It's about building a diversified portfolio of investments that automatically track the market as a whole, rather than trying to beat it. The core belief behind passive investing is that consistently trying to pick winning stocks or time the market is incredibly difficult, even for professionals. Instead, by investing in a broad market index, you are essentially betting on the overall growth of the economy. Think of it like this: instead of trying to guess which individual tree in a forest will grow the tallest, you are investing in the entire forest. Over time, forests tend to grow. Now, why is this so powerful? Two main reasons: diversification and low costs. When you invest in an index, you're instantly diversified across hundreds, if not thousands, of companies. If one company struggles, it's a tiny blip on your overall portfolio. This significantly reduces your risk compared to putting all your eggs in one basket. Secondly, passive investments, particularly those held through platforms like Wealthsimple, typically have very low fees. Active management often comes with hefty charges that eat into your returns over the long run. These seemingly small differences in fees can translate to tens, even hundreds of thousands of dollars, over a lifetime of investing. So, how does Wealthsimple fit into this picture? Wealthsimple is a leading Canadian online investment management service, often referred to as a robo-advisor. This means it uses algorithms to manage your investments automatically, based on your financial goals and risk tolerance. It takes the complexity out of investing, making it accessible and affordable for everyone, from seasoned investors to complete beginners. Let's break down the journey of passive investing with Wealthsimple, step by step. Step 1. Setting up your Wealthsimple account, your financial launchpad. The first thing you'll need to do is open a Wealthsimple account. The process is surprisingly straightforward and can be completed entirely online. You'll visit their website or download their app, and you'll be guided through a series of questions. This isn't just bureaucratic red tape. These questions are crucial for Wealthsimple to understand your financial profile. They'll ask about your investment goals. Are you saving for a down payment on a house, retirement, your child's education, or just building general wealth? They'll inquire about your income, your current assets, and your liabilities. This helps them get a complete picture of your financial health. Crucially, they'll also assess your risk tolerance. This is a big one. Are you comfortable with the ups and downs of the market, or do you prefer a more conservative approach? They'll present you with scenarios, like if your portfolio dropped by 10% in a month, how would you feel? Your answers here directly influence the type of portfolio they recommend. A higher risk tolerance might mean a greater allocation to stocks, which have higher potential returns but also higher volatility. A lower risk tolerance will lean towards more bonds, which are generally more stable but offer lower returns. This personalized assessment is a cornerstone of Wealthsimple's approach to passive investing, ensuring your portfolio aligns with your comfort level. Finally, you'll need to link your bank account. This is how you'll fund your investments and, eventually, withdraw your money. Wealthsimple uses bank-grade security to protect your information, so you can rest assured that your financial data is safe. Step 2. Funding your account, the fuel for your financial growth. Once your account is set up, it's time to add some funds. Wealthsimple offers a few convenient ways to do this. You can make a one-time deposit, which is great if you have a lump sum of money you want to invest. However, the true power of passive investing, especially for those just starting out, lies in automation. Wealthsimple encourages setting up recurring deposits. You can choose to contribute weekly, bi-weekly, or monthly. Even small, consistent contributions add up significantly over time due to the magic of compound interest. Think of it like a snowball rolling downhill. The longer it rolls, the more snow it picks up, and the faster it grows. Your regular contributions are the fresh snow, and compound interest is the ever-accelerating momentum. This disciplined approach eliminates the need to time the market, which, as we discussed, is almost impossible. Instead, you're consistently buying investments, regardless of market fluctuations. This strategy is known as dollar-cost averaging, and it's a fundamental principle of successful passive investing. Step 3. Your personalized portfolio, the engine of your wealth. This is where Wealthsimple's robo-advisor truly shines. Based on the information you provided during the onboarding process, your goals, your time horizon, and your risk tolerance, Wealthsimple will construct a personalized portfolio for you. You won't be picking individual stocks or bonds. Instead, your portfolio will be made up of exchange-traded funds, ETFs. What are ETFs? Think of an ETF as a basket of different investments, like stocks or bonds, that trades on a stock exchange. When you buy shares in an ETF, you're essentially buying a small piece of that entire basket. This is how Wealthsimple achieves broad diversification for you. Wealthsimple invests in a diversified mix of ETFs that track various market indexes. For example, your portfolio might include Canadian equity ETFs. These track the performance of the Canadian stock market. U.S. equity ETFs. These track the performance of the U.S. stock market. International equity ETFs. These track the performance of global stock markets outside of North America. Bond ETFs. These invest in a variety of bonds, which are essentially loans to governments or corporations. Bonds generally offer lower returns but are less volatile than stocks, providing stability to your portfolio. Real estate ETFs. Some portfolios may also include ETFs that track the performance of real estate investments. With that said, thanks for watching, and until next time.